It's a great pleasure to introduce our next instructor based in Westchester, Pennsylvania. Glenn Surowiec, many of you will know, started GDS Investments in 2012. Over the prior decade, he worked at Alcin Capital Management, first as an equity research analyst and later as portfolio manager. Glenn holds a BA in management from Gettysburg College and an MBA from Southern Methodist University. Glenn has very generously shared his wisdom and ideas with our members in the past, and we are grateful he has chosen this opportunity to be with us again. So on behalf of the MOI Global membership community, a very warm welcome to you, Glenn.
Thank you, John. Glad to be here. This is one of the best conferences, and certainly happy to be joining again.
Well, I wanted to be sure to have you as a part of it. We're doing something a little bit different today. So instead of a formal presentation, we're going to have a Q&A. And so perhaps we could just start with having you give us a little bit of an assessment of your own portfolio and your own outlook going forward.
Okay, well let's maybe start a little bit about kind of investment philosophy. So obviously, I'm a value investor, and I definitely subscribe to the belief that price is what you pay and value is what you get. I am definitely in the camp that looks for higher quality companies, companies that can compound at a acceptable rate of return over a long period of time. And so that typically leads me to companies that are industry leaders, that have high return on invested capital, and that have really wise stewards and leadership to manage the whole capital allocation process. And I would say that my portfolio is it's definitely a low turnover portfolio. It's definitely looking, companies that are, not only, cheap today, but maybe cheap and misunderstood. And, I might have a different perspective, over the long term than maybe the market has. I think that, a cornerstone of, I think, of value investing is having the emotional discipline to think long term in an increasingly short term world. And I am of the belief that there aren't dozens and dozens of great ideas at any one time, at least in a typical market environment. So that leads me to, be an inch wide and a mile deep, if you will. I would rather own just a handful, maybe a dozen, 15 different companies that I really, really understand, and that are, truly meet all of the different valuation criteria that I have.
Terrific. And Glenn, maybe we can go to an example. I think GE is a company you know quite well. It's obviously in the crosshairs right now, but how do you look at something like that in terms of taking a longer term view?
So, all right. So GE probably is. I'm definitely happy to talk about GE. I would say, just to kind of put it in the context of other companies I own, I would say it's probably a deeper turnaround. I still own it, and I think sometimes, and I own it obviously at higher prices. So and I'm totally happy to admit that. But I think that sometimes when you have, large unrealized losses, I think that it becomes indistinguishable whether you're wrong or early. And I think in situations like GE, and I'm glad you brought it up, I think it's important to just kind of, reset everything, recheck your facts, and make sure that if the logic is still in place, that, you don't let volatility kind of guide what you think might be appropriate long-term decisions. But Obviously, lots of different news with GE in 2018. I think John Flannery had, really done a decent job taking over for Jeff Immelt, and I think he was able to, in some ways, redirect the company down a different path, a path that Jeff Immelt was more marked by overpriced acquisitions, whether it was their own stock or whether it was Alstom within GE Energy and Power, or Baker Hughes. And I think Jeff Immelt had basically spread the company really, really wide, and he did so in a very undisciplined way. And I felt that what John Flannery was doing in terms of simplifying the organization, restructuring Power, and really kind of building the next generation of GE around aviation and healthcare, I think was the right move. And in October, John Flannery was let go, and they brought in Larry Culp. And when I say brought in, he was already a member of the board. He came in February, and I think Larry Culp has an exceptional track record. He ran Danaher for 14 years, from 2000 to 2014. Danaher's market cap and revenue grew fivefold over that period. And Danaher is sort of one of those companies that most investors and most lay people have never heard of. But in some ways, it's almost the antithesis of how to run a conglomerate in the way GE is. It has 60,000 employees and less than 200 work in corporate headquarters in Washington, D.C. So I think what he was bringing there was just a change in culture. He's very much rooted in, leadership should be out in the field. He's got a phenomenal track record, and I think he will continue to do what John Flannery started. I think the difference is going to be, I think he's going to accelerate some of those changes. And I think he's going to bring in additional liquidity quicker than maybe John Flannery was able to do so. And I think more importantly, I think culturally they needed to send a signal that, okay, this is an outsider. For a company for like GE to really bring in an outsider, I think it's just really telling, in that this is something that they wanted to communicate, that this is a serious problem. This is something that they're going to attack, and this isn't something they're going to attack at a very, very very quick, fast-paced approach. And so I think if you look at GE, I think that there's sort of, there's the good and the bad. And I think, GE Capital continues to unwind and is essentially in runoff mode. I think there's some legacy liabilities that they're trying to address and they're trying to reserve for, that can possibly be, those risks could potentially be offloaded through a reinsurance transaction. I think they're trying to do something with Baker Hughes, the publicly traded BHGE, that they telegraphed to the market. And I think they're trying to do something with GE Healthcare via a IPO or spinoff or some other corporate transaction. And, Power is still a work in process, and I think they're obviously addressing it. But I do think that if you can separate the bad stuff and really restructure around the good stuff, not dissimilar to what Bank of America was trying to do. So one of my more successful investments was Bank of America. And I originally invested at $10 a share, and this was after 2008, 2009. So it wasn't at the height of the crisis, but it was still, they still had a lot of lingering issues. And I thought Brian Moynihan really was doing a lot of great things. And the market was still concerned about a lot of the legacy mortgage operations. And I think they failed to realize that there was a lot of, they failed to realize two things. A lot of progress had been made with the core long-term businesses. But number two, a lot of the profitability was understated because they were supporting this legacy mortgage business. And so with that, the overhead was higher than it should have been. But I first bought it at 10, and averaged down, and it ultimately bottomed at around $5. And so obviously I had large unrealized losses there, but I felt that the company was really putting the business on the right track, and now it's somewhere between 25, 26, $27. And I think GE, with the right execution, and again, I'm a big fan of Larry Culp, I think GE can carve out a similar trajectory that Bank of America did.
So my question, it seems the valuation on GE has come down so much that if they can get through this period without dilution, that it's going to, the upside will be intact. I mean, what's your level of confidence in terms of them being able to weather this without issuing equity?
Well, it's a good question. I think the market is already discounting some sort of dilution, and I'm not. So they just cut the dividend. So obviously there's an eye on reallocating capital around different priorities. I think it all depends on obviously if there's a continued deterioration in power. I would say that if some of these contingent liabilities turn out to be greater, and or if they can't offload that risk to a reinsurance company, or if they're not able to generate the kind of liquidity that they want, through. So they announced a $92 million share offering in BHGE and a secondary. And so, there are things that they're doing to address near-term liquidity, kind of absent from issuing equity. I don't know that anything is off the table. I think Larry Culp is certainly going to do what's in the best interest of long-term shareholders, and I think that if he thinks that maybe so Bank of America did the same thing where they issued convertible preferred stock to Warren Buffett, and I think there was a near-term reaction, but in the long term it probably made sense. And so you have to kind of weigh that balance where they did bring in someone of his stature, and I think in some ways, was it dilutive? Possibly. It depends on how you look at it. Was it necessary? Maybe, depending on hindsight's 2020. Maybe not. I mean, maybe they could have gotten by without it. But I think it really de-risked the company in a way where it allowed them to kind of move and focus on things outside of the liquidity and the capital structure, and allowed them to really just go down a different path and know that they had a comfort of having someone like Warren Buffett that ultimately was going to become a major shareholder. So I think sometimes in the near term, dilution has has an obvious negative impact, but in the long term, not all dilution is sort of created equal. I think that if you can bring in a partner and really kind of, take a risk off the table, such as liquidity, then I think it's important. But I do, putting the dilution thing aside, I do think they have other levers to pull. And I don't know that it's the first option, but I don't know that it's off the table either. But the fact that they just basically eliminated the dividend, or they cut it to a penny, they're looking at a lot of different things. And I think what they sense is that there's prices and there's markets for a lot of these different assets. And I don't know that they're necessarily locked into any particular path. I can tell you that Larry Culp, at least based on what he did at Danaher, is that he's, I think what he's locked into is creating long-term shareholder value. And if it means pursuing, one strategy or a different one, or a hybrid of the two, or then I think he'll do what's financially responsible.
And are his incentives aligned with the long-term shareholder gains?
They are, yeah. So it's very much skewed toward equity. And not only has he been a buyer in the open market, but yes, I would the vast majority of how he's going to get paid is directly aligned with equity owners.
That's very helpful. Glenn, maybe stepping back a little bit, and you talked a little bit about philosophy in the beginning, but I know you are on the lookout not just for cheap and undervalued, but also quality. What do you look for when you say quality? Is it more the business or the management team?
So, okay, so that's a good question. I mean, I think it's so the first thing that I try to do is I think it all starts with yourself, right? So I mean, at the end of the day, and I think that these things come up in a lot of the conferences that you put on, and you have a lot of different value investors who kind of do things and they operate differently, and some have lots of they have an investment committee, and some operate with just a single person making decisions, and so I'm more the latter. I mean, there's a group of people that I network with, and I think that's healthy. But in terms of having final say over decision, I think you really have to understand what kinds of companies you need to own in order to win long term. And there's lots of people that can do the whole I'll buy $1 and pay 60 cents a la Ben Graham, and they look for those kinds of cigar butts, and they can be highly successful. And I would say my philosophy it's over just I don't want to say trial and error, because I directionally I started down this approach, but my winning formula is pretty simple, right? So I talked about, to me it's price is what you pay, value is what you get, and if I personally need value, I need the denominator in that equation to go up, which means I'm looking for businesses that are getting more and more valuable every year. And how they go up is different. I mean, some do it through just measured acquisitions. Some have pricing power. Some are just trying to increase the scope of what they do. Some of it is just through economies of scale. I mean, there's a variety of ways that you can increase the value of a company, and some are doing it maybe through opportunistic share repurchases. But there's I've owned companies where you have John Malone, who kind of does his thing, and maybe he uses more leverage, and his is more maybe tax driven, and he's dealing with a certain industry. And I've owned companies that Vernon Hill has been part of, and he is more de novo organic expansion, where literally he's taking a model that works, and he's building another brand, another store, a la Home Depot or McDonald's. And so I am pretty indifferent. I just want to make sure that the value is going up. And so the kinds of companies that I look for, I feel most secure, and my clients feel most secure when I own number one or number two companies in their industry. And I don't like to deviate. And typically, if the industry operates as a duopoly, then all the better. A number one with like 9% market share, where it's highly fragmented, is different than a number one that's got 35% market share, and the next closest competitor might be at 20, where in the other let's say there's 15 competitors that make up the remaining 40%. I much prefer the latter. Capital structure, I think we kind of talked about with GE, and GE kind of falls outside of this a little bit. But most of my companies are extremely conservatively financed. And that's not saying, I mean, I think that I'm not interested in companies that are trying to maximize sort of, economic theory when it comes to leverage, because I think sometimes you're not building the capital structure around the most likely event, you're building it around the more, the 100-year flood, if you will. And I'd rather companies really operate with that kind of mindset. We talked about management teams, and just to sort of introduce a Will Thorndike reference. I mean, I'm looking for outsider CEOs, and I think that there's a huge tailwind to being in a good to great business and having a management team that is a tailwind and not a headwind. Because there's a lot of management teams that can come in and destroy a great business because they're essentially renting their job. They're in there, they know they have 5 years to make a difference, and they're trying to hit home run after home run after home run. When maybe singles and doubles are just a little more suitable for what they're trying to do. So I am definitely looking for outsider CEOs, and I think the way you identify that is obviously you want to look at how they allocated capital in the past. You want to talk to them if possible. You want to listen to what they say and what they do. You want to read 10Ks. And I think through that process, what becomes evident is that there's a lot of CEOs that came through the organization through the sales channel. And, without generalizing, I have found a lot of those CEOs to be dangerous. I think I would much prefer a less charismatic CEO and someone who is more, operationally savvy, someone who understands the manufacturing process. I would rather, a CEO who, understands the finance piece of the business, as opposed to someone who constantly needs to defer to the CFO. And because at the end of the day, I think if you have a CEO that really takes ownership over every aspect of the organization, and you have a CEO that understands that, we have, a reallocation of capital process that will either, create or destroy value for shareholders, and we're going to be completely agnostic whether it comes to paying dividends or buying back stock or maybe pursuing M&A or maybe reinvesting in our own business, but they're going to choose the path that's most appropriate. Then those are CEOs that I want to align myself with. I mean, whenever I hear CEOs say, "Yeah, we bought back stock because we wanted to offset dilution in equity compensation," I say, well, that doesn't make any sense. If your stock's overvalued, then why are you buying back stock? Maybe dilution isn't such a bad idea. Or if you have companies that are issuing debt, when their stock is overvalued, it's like, well, that doesn't make any sense. Anyway, I think that gives you at least just a window into, at least on a preliminary basis, some of the things I'm looking for.
Absolutely. One other thing I'm curious about, what your take is. There's been quite a lot said, and I think it's kind of accepted wisdom now, that brands are not necessarily what they used to be, at least some brands or a lot of brands. So how do you look at just kind of the pace of innovation and the pace of destruction of some types of moats that have historically been viewed as wide? And has it at all kind of pushed you toward expanding the circle of competence, maybe looking at companies in the technology space at all?
Well, I do own companies in the technology space, and I own quite a few of them. And so let's get back to the question. And I think there's no question that the life cycle of companies is gotten shorter and shorter, and there's a level of disruption that's happening. But disruption kind of cuts both ways. I think it's I think it means opportunity, and it also means that companies are going to be on the other side of that of that force. And I think certain industries that for decades and decades sort of had this reputation of having moats and having pricing power. It's just not true. And I would say that if you think through like a Kraft or newspaper companies or a lot of these traditional moats like in consumer products and things like Colgate, these steady eddies where people thought, okay, these are the companies I really want to own during the recession, and they have pricing power. And I'm not sure that that's true. I think that they are very, very vulnerable. I have stayed away from them. And I think there are other companies where there is a very, very real moat. I do look at things like Net Promoter Score to just kind of look at which brands consumers value. And you can, Net Promoter Score is just kind of one data point, but I think you can look at other data points to, support that. And I think you have to be very, very mindful of an environment because of the pace of technology and the pace of that change. Moats are obviously not what they used to be. And I think that I think you do need to, I don't know about expanding your circle, but I would say maybe redrawing it is the right way to think about it. And the irony is that companies that quote have moats today, I think may be vulnerable. I mean, I think that, and I don't want to pick on Apple because I think Apple, obviously there's a moat there. They have a huge ecosystem, but there's also, if you look at what's happening in the Valley, I think there's a lot of companies that are opening up like second and third and fourth lines of business. And I think that, there used to be, really a clear separation between maybe what Apple and what Google was doing, what Amazon was doing, and maybe what Alibaba was doing. And I think that those lines are kind of getting blurrier and blurrier. So I hope that answers your question. The obviously, without question, you really have to be mindful of moats changing. You have to be mindful of a company's competitive situation. I think, there are companies today that are definitely high moat companies that, and I think Jeff Bezos made reference to this either in his last shareholder letter or maybe I read it somewhere, but he said, listen, at the end of the day, we will get disrupted. And, so you really need to build an organization that kind of has that edge to it where they're not kind of stuck in the mud. Yeah, I mean, that's it. It is just that's the world we live in. And I think it's not universally good and it's not universally bad. I think it's just definitely, something that needs to be evaluated when you're going through the investment process.
And to the extent you're willing to talk about it, I'd be curious just what kinds of technology-related companies you found to have value.
Okay. Well, how about I nibble around that a little bit?
Sure.
Yeah, so I would say so one company that I've owned for a while is Qualcomm, and so it's maybe not a traditional technology company the way that a lot of people think about technology, but I do think that there's a there's a long-term earnings growth story that's in place. I like what they're doing after the NXPI acquisition failed because they didn't get Chinese regulatory approval and they engaged in a massive buyback at prices that were very, very accretive. And I think there's some overhang because of the licensing dispute with Apple. So that's a company I like. I think they have a very rich pipeline. They spend an enormous amount of money on R&D, and in combination of the fact that they're shrinking the denominator in the earnings per share calculation, and the fact that they are on the wave of a lot of emerging technologies. I'm comfortable owning Qualcomm. Some other companies I would say that have come down, so without getting into any specifics, but I think that if you sort of venture into some of these emerging markets, China, if you take some of the bigger companies there, I think they've kind of come down to very interesting levels. Companies that are very, very entrenched, almost in a similar way that Google is with, domestic search. And Amazon is with domestic e-commerce and cloud. I think that the emerging market names, because of some of the trade angst, I think that they've come down quite a bit. Those are in my portfolio, and they are very, very interesting to me. So I think that at least gives you a flavor. I have owned sort of the FANG names at one point or another over the life of GDS investments. I do not own them right now. And they've all done quite well, and I was early in getting them out of the portfolio, but I was right in my entry price. But I think that so if you look at Apple, and there was a lot of kind of confusion about their ability to kind of reinvent things after Steve Jobs, and I was very, very comfortable with what Tim Cook was doing. Initiated position then, did very very well. But my concern is that I think, not that they've come full circle. Certainly, it's off a lot from the last month or two. But I think when you're dealing with $1 trillion companies, I think that the next leg of growth gets difficult, and so it's not really a bet I want to make. I think that they're going to have to kind of really. So if you look at the upgrade cycle that we've seen with, really the core smartphone product, I think you're going to see it get longer and longer, and I think each new innovation will get, you'll be less inclined to upgrade, and I think you're starting to kind of see that now. So I think the ecosystem will be there, but I'm not sure that people are going to line up to pay $1,200 for the next generation phone when they see maybe 5% improvement. So when you have the price that continues to go up, but the rate of improvements coming down, I think that's an uncomfortable intersection to be at. So that's sort of what I've been doing lately in technology.
Great, that's very helpful. I'd be curious also, Glenn, how you think about holding cash, both in general as well as in this kind of a market environment that might be a late stage bull market. We're getting some jitters now. How do you think about cash in the portfolio?
I think about cash not necessarily in a top-down way, but more sort of in a bottom-up way. So if I have ideas and I'm, and if I have more great ideas in cash, then I like to be close to fully invested. And, if I am staring at the opposite dynamic, then I certainly like to build up cash. And so I think if you look at my history, I've been anywhere from 0 to 30% cash, depending on the opportunity set. So I think what's happening now is I think, um, obviously the economy is slowing, and I think that people are nervous about that, and I think that nervousness is certainly, if you look at individual names, I mean, if you look at the Caterpillars and the Dow DuPonts and names that are traditionally economically sensitive, they're obviously pricing in some of that, right? I mean, Dow DuPont, they got a great CEO and Ed Breen that did wonderful things at Tyco. They're going to break up the company, and I think there's going to be more value as they do that into 2019, 2020, yet it's sitting at multi-year lows. So it's, there's obviously some recognition that our economy is slowing down when I look at bellwethers like that. And just, I don't own Caterpillar, but I do own Dow DuPont. And I actually think directionally, our market is more similar to the late 90s, where I think you had this huge concentration of capital misallocation into some of the growthier names. And I think if you look at the disparity between the Russell 1000 growth versus Russell 1000 value, I actually think a slowing economy is going to be a catalyst for rotation into value. And so I think that's kind of the missing ingredient. I think people will become more price conscious when the growth isn't there. And so I am actually less than 10% in cash right now. And I've sort of used the volatility in September and October and November to do two things: work in cash and upgrade the portfolio and reroute away from things that maybe have gone up and or companies that maybe carry a little bit of business risk into companies that I think are absolutely bulletproof and are cheap and have just very, very good structural tailwinds in place over the next 5 to 10 years. And so I'm actually encouraged that, if we do get a slowing economy, and if that forces investors to reprice certain growthier assets, then I think that net, I think that's an advantage for value-oriented managers.
You've talked about Commerce Bancorp in the past.
I have.
Could you tell us a little bit, give us an update on it? Has that developed the way you expected it to? And do you consider that one of those solid pillars, if you will?
So I owned Commerce for a really, really long time. It was a 15-year holding up until it was sold in 2007 to TD Bank, and I have since participated in two sort of Vernon Hill ventures. The first is Republic Bank, which is a small bank in Philadelphia that he's involved in, that has a lot of the similar kind of de novo expansion that Commerce was so famous for. And it's, now around $7-8, and my basis in that is about $1.50. And what's also interesting is his venture in the UK. And he's involved with a bank called Metro Bank, and I own Metro Bank. And I think what I like about it, outside of the obvious, okay, so you have Vernon's involvement, and you have a formula that was highly successful in the States. I actually think that the model over in the UK is going to work better than it did in the States. And I say that only because the UK banking system is essentially, there hasn't been a single new bank charter granted since 1840. So you're essentially walking into an industry that is so ripe for disruption. And so you have sort of this maverick in Vernon Hill, and you have competitors that are incapable of dealing with this new way of bringing in deposits, because the HSBCs and the Barclays and a lot of these 4 or 5 banks that control 98% of the market share, they haven't reinvested in a retail banking business, and they haven't hired. Their culture isn't really suited to bring in deposits. And I think you have these 6 legacy banks that are very out of step, very bureaucratic, and I think if you and I say I think, but my confidence is a lot higher than that. If you talk to customers of these legacy banks, they're there not because of any underlying goodwill, right? There's no relationship goodwill. They're there because there's a lack of alternatives. And so I always I bring it back to other models, like so did people go to Heckinger's and Builder Square and Grossman's because they absolutely loved the experience, or did they go there because there wasn't a Home Depot's? And so it was the latter, and so they were there temporarily. But I think what I've always been fascinated by are models that are just on the verge of being disrupted. They don't know that because they overestimate how much loyalty that you have. And you see a model that's coming around, and you see really the distinction between, in this case, deposits that are there for all the right reasons. So, I mean, Commerce was bringing in deposits for all the right reasons. They didn't have customers, they had fans. And they had people that really thought of them as just, a relationship that they could not do without. And it was because of, friendly service. It was because they were open 7 days a week. It was because that they could go there before and after work and know that the bank was going to be open. It was there because their lenders were known to, just work with businesses throughout the economic cycle, where other lenders were known to kind of just really kind of cut off lending during recessions and things like that. And so I think Metro is really, really in a very, very good position, in that they are just scratching the surface for what I think is going to be a decade or 2-decade long runway. So I own Metro, I own Republic Bank, and having studied Commerce's model, and having worked there, and having just relationships with people there, it just gives you an advantage just to really understand what's happening there, and just really how powerful of a model this is. I am very, very bullish on both of those businesses.
Well, that's, I think, very interesting, particularly at this time, because Metro Bank has come off, probably because of Brexit and those kinds of concerns, which obviously have nothing to do with the long-term economics of the business. So it seems like it might be a good time to look at Metro Bank.
It would be a great time.
Glenn, I'm going to leave it there. Thank you so much. It's always a pleasure. When we do these Q&As, we never quite know where it's going to go, but I always end up learning a lot, and I'm sure those listening have picked up some things to follow up on as well. So thank you so much for taking the time to do this.
It's my pleasure, John. Thanks as always, and I really enjoyed this format.
Best wishes and goodbye for now.
Okay. We'll talk soon, John. Take care.